Good morning, and thank you for being here. My name is Paul Hewitt. I'm the Executive Chairman and the CEO of RNC Minerals. I've just taken on the role of CEO about 70 days ago. It's pretty fresh, but I'm happy here to talk to you about the company because there's been an awful lot of change in that short period. So one of the things some of you may or may not know about RNC was predominantly a nickel company. The name Royal Nickel stands out for itself. In the last several months, the board has made a conscious decision to refocus the company and gain control of the company in a different way. So we're really focused on our Western Australia assets. And some of the things you'll see here today are one of the only thing that hasn't changed in this short period is actually the name, and we're considering that, actually. So what's happened? So first, we made changes at the board level with the addition of myself. We made changes with Warwick Morley-Jepson, who's the executive chairman of West Dome, former COO of Kinross, and Wendy Kai. That added to a very strong nickel board. While we still own that asset in Quebec, that Dumont asset, we only own 28% of that asset. So that's why we decided to focus on our 100% owned assets in Western Australia. And at the time that I joined, we had one asset, the Beta Hunt mine, and it's really well known for the astonishing specimens that have been discovered in the last year from the Father's Day discovery. That's made world international news. A lot of people understand it. It created a lot of excitement, and we're still very excited about it. Some of the changes we made were really long-term changes so that we could demonstrate that this operation could be profitable and on its own at the average grade of the deposit without those high-grade specimens. So since June, we actually went on a hunt to acquire a new mill, and we acquired the Higginsville operations, which included a mill and a mine, and that open pit that you see here on the top right-hand picture. Today, we're feeding that mill. We closed in about June 15th. We're feeding that mill at 50% capacity from this open pit that you see here. It's a very high-grade open pit. In fact, it's about 2.2 gram, the average grade, and it's all free digging. This was part of our purchase for $50 million when we bought the Higginsville asset. We got three things when we got the Higginsville asset. We got that blue open pit that was bought by the previous company the year before for $9 million. We got a 4,000 ton a day mill, and I'll show pictures of it afterwards. I just don't want to flip forward because I don't think I can go backwards. The mill is at capacity today, 50% from this, and the other 50% comes from our Beta Hunt operation that yielded those specimens. In the last several months, we've done a big 40,000 meter drill program at the Beta Hunt mine. We've added to that resource. So it grew in the measured and indicated areas by 400% and the inferred by 200%. So the point of this is today, as a company, we now have two assets, two different mines, one open pit, one underground in Western Australia. We're feeding a centralized mill. We're at an average run rate already since June of about 100,000 ounces a year. And here's our report card. Here's our results. You can see in the month of July there, our first month in the company's history of our own mill after we closed and feeding it with all our ore, we did just short of 8,000 ounces. Our next month is August, we did 8,100 ounces. And then comes September, we did 8,239 ounces. So our first quarter in the company's history, we managed to do 24,000 ounces, while the first half of the year, we did 14,000 ounces. That's a huge change for this company and a huge different strategy from the previous strategy that we had. One of the things that we're looking at doing, because we're really focused in Australia and we've got a strong team in Australia, is looking at getting an ASX listing in 2020. So hopefully we can get that done in the first half of the year. The other thing before I switch slides here, I just want to point to the production that we've put out. Again, this is a first-time event for our company. We've just put out guidance of 42 to 49,000 ounces for the second half of 2019. at an AISC cost of $11.50 to $12.50. And we're certainly not satisfied with that AISC. We are aggressively working at reducing that, and let me show you some ways how we're going to reduce that. And these AISC numbers and this guidance that we're putting together excludes any of those high-grade specimens that we could find along the way. And when I say could find along the way, in fact, as early as yesterday, we put out a press release. In an area of the mine that we were supposed to have 30 to 45 ounces, we ended up with 3,200 ounces. On September 24th, in another area about 400 feet away from that same zone, we were supposed to have 20 ounces in our model because our models are capped. We ended up having 1,750 ounces of high-grade specimens. So just to put it into perspective, in Q4, we're going to have an additional 5,000 ounces of specimen gold. That's, at $2,200 an ounce gold in Australia, that's over $10 million. That goes right to our bottom line. That's going to be added right to our treasury. So some of the things that's important for any company is to have a strong management team. You can have the greatest asset in the world, but without a strong team, it will struggle. So I've joined on the board and as CEO, but more importantly, we've added, one of the first hires I did was Graham Sloan. He's the managing director in Australia, and he runs all our operations. He's responsible for everything in Western Australia. He's the former CEO of Perseverance, who built the Fosterville mine. That doesn't need any introduction in today's world. Everybody is familiar with Fosterville. From 2002 to 2007, he was the CEO. He was also CEO of 2 other companies, so he has an excellent track record in Western Australia. He knows the people, he knows the area, he knows the agencies. He's a tremendous value for us. The first thing Graham did is he hired 2 new general managers for us. Part of his team are Greg Harvey and Cullum Wynn, general managers at both our operating mines. And just to give you an understanding of one metric on its own, since Graham and his team have joined, our turnover rate in Western Australia used to be 87%. It was a revolving door coming into that mine. Even though it's a fly-in camp, we had people coming in for one turnaround and then never returning. Since they've joined, that turnover rate has dropped by it's down to 19%. So from 87 to 19%, that has a tremendous impact on our costs. You'll see that flow into our all-in sustaining costs and our future goal of $1,000 an ounce. It also has a huge impact on our productivity rates. We're seeing tremendous increases in efficiencies underground, like 30 to 40% in some areas. This is actually a picture of our mill that we just acquired in June. This mill was built in 2009. It's in very good condition. Over the last 20 years of my career as mine manager, general manager, VP of operations, and COO of other companies, I've had at least 9 mills report to me. This mill is in extremely good condition. I spent 5 days going through the whole facility. It was built in 2009 for $100 million. It would take us at least 3 years to permit that, and very close to $100 million, if not more, to build it. We paid $50 million for the mill and also for this land package. This land package includes 1.9 million ounces. So as a board, we actually decided to assign $25 million to the ounces, 1.9 million ounces. That's about $13 an ounce Australian for acquisition costs, and then $25 million for the mill. So that's 25 cents on the dollar. I'll just get to I know this is a quick session, so I just want to highlight how we're driving and where we're going to get to the costs, and then one more quick slide. Obviously, acquiring the mill, you can see on the bottom of the slide, our toll milling costs that we were doing in the first half of the year were at $45 a ton. We're now milling at $29 a ton, but we also realize a benefit of at least 2 to 3% increase in recoveries. We're going to be focused in 4 areas to reduce our costs. We're going to approach vendors. We now have buying power. Personnel, I've talked about changes throughout the board, executive team, the management team, throughout the miners. And then we're looking at royalties as well. We're really focused on royalties and reducing G&A. And then just this last long section just shows you how often we've hit these high-grade specimens. So you can see all those stars. That's a ½ kilometer strike length. Our deposit is 4 kilometers in strike, and we're mining 3 different shears. This is a zone, just one area where we're mining it. And you can see how frequent we've hit these high-grade specimens, and that world-class one, that 30,000-ounce Father's Day is right there. The good news about this is that this was all intercepted just by drifting. We haven't taken any of these stopes out. And I better walk off here, I think. Thanks very much.